Good morning, families. Welcome back to the American Family Survival Network and American Family Survival Channel. I'm your host, Jeffrey Snipes. And yes, I'm sitting in my car, but I am parked, so no worries. This comes from Zero Hedge, Deutsche Bank. The U.S. may now be in a recession. 3 months ago, we presented an analysis which showed something disturbing. According to Deutsche, the current business cycle is already the fourth longest in the post-World War II period, and the corporate debt-to-GDP ratio suggests that imbalances are building, and that worse, as a result of soaring corporate debt and rolling over profit margins, a recession could hit as soon as the second half. Overnight and 3 months since its last such analysis, Deutsche Bank has published an update. It shows that, as illustrated in the chart below, profits per worker have generally trended higher over time. This is a function of productivity gains and inflation. However, this time has changed in recent years. In the current business cycle, margins peaked at $18,752 per worker at quarter 4 of 2014. This compares to a ratio of $16,487 per worker as of quarter 2, 2016. Margins have fallen because corporate profits have declined, negative 6.3%, annualized over the past 6 quarters, while private sector job growth over this period has been very steady at around 2.1%. So here's the map, or the image of the graph that they were discussing, and it starts down here and goes up here like that, and that's showing the corporate profits per private worker. But as you can see, it's starting to decline here. Right, there's a decline there. So, as before, we get the usual, but you must exclude energy complaints. We wonder why. It is becoming increasingly obvious that oil is not going back to $100. So the new norm oil may well be crude at $50 or lower, which means including all energy-related data. Here it is, the punchline. It's excluded. As of the latest sector-level data available through quarter 1 of this year, domestic profits excluding petroleum and coal products and Federal Reserve banks were down negative 5.2% compared to a year ago. In fact, the series has been declining in year-over-year terms since quarter 2, 2015. This means that recent overall margin compression has had less to do with the strengthening dollar and depressed energy prices, and more to do with weak domestic demand, coupled with near-zero growth and non-farm business productivity. From quarter 4 2014, when profit margins peaked, to quarter 2 2016, domestic profits have declined by a little less than $200 billion. As we can see in the charts below, this compares to a negligible $10 billion decline in profits from outside the U.S., over the same period. Not surprisingly, the decline in profit growth has occurred alongside a deceleration in domestic demand. The year-over-year growth rate of real final sales to private domestic purchases peaked at 3.9% in 2015 and has since slowed to 2.3% as of last quarter. So here's another chart for you. And what this shows is your domestic profits, corporate profits per employee, domestic industries. So we can see that it was going pretty steady here for a while, and then went up, and then came drastically down here, and then started going back up, and now it's starting to come back down again. And again, that's the corporate profits per employee of domestic industries. So why are margins important? Because we noted in our June note, margins always lead in economic contraction and always peak in advance of a recession. There has not been one business cycle in the post-World War II era where this has not been the case. The reasons margins are a leading indicator is simple. When corporate profitability declines, a pullback in spending and hiring eventually ensues. Thus far, firms have reacted to declining profit growth by cutting back on capital spending and inventory accumulation, and have kept layoffs to a minimum. For example, real non-residential fixed investment has declined negative 0.2% annualized over the last 6 quarters. However, this has done little to stem the tide of margin compression because, unfortunately, productivity growth has been just 0.1% annualized over the same period. While unit labor costs are up 2.4%, this highlights a major risk that we see to the labor market at present. Normal income growth continues to outpace nominal GDP, a terrible situation for corporate profitability. In light of collapsing productivity, declining domestic demand, and sliding growth of real final sales, how has the U.S. corporate sector avoided a full-blown recession so far? Simple. It has been loading up on debt to mask the income statement effects of declining demand. As DB calculates, the corporate sector has taken on a substantial amount of debt in the current business cycle. Non-financial corporate debt has increased by 4.5 trillion from its trough in quarter 4 of 2009. The latest corporate debt data corresponds to quarter 1 of 2016. As illustrated in the chart below, the ratio of non-financial corporate debt to nominal GDP is at its highest level since quarter 1 of 2009, when the economy was still in recession and nominal output was substantially depressed. Alongside tepid demand, the weakness in corporate balance sheets means that the Fed needs to be alert to any possible tightening in financial conditions. For one reason, based on nominal corporate balance sheets, the U.S. is already effectively in recession. The only thing preventing the hammer from falling are record low interest rates, keeping interest coverage ratios at all-time lows. So if the corporate balance sheet screams recession, what does the corporate income statement say? Well, the average and median lead times between the peak in margins and the onset of recession are 9 and 8 quarters, respectively. This would imply the second half of 2016. To be sure, as shown in the table below, the time period between the peak in profit margins and the beginning of recession varies substantially across business cycles. 1960s and 90s business cycles. In the former period, the peak in margins occurred 16 quarters before recession. In the later episode, the peak occurred 15 quarters ahead of the economy's entering recession. Conceivably, such a scenario could unfold now. So the point is, folks, go to the American Family Survival Store for all your family's emergency and survival needs today. Thank you so much. God bless, and fear not.